Hello, everybody. Welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani, and I'm joined today by a trio of splendid guests. Tom Lydon is the head of the ETF Trends. Todd Rosenbluth is at CFRA, and Jason Bloom is the director of global macro ETF strategy over at Invesco. Thank you all for joining us. It's oil ETFs again, folks. We talked about this last week. USO changing its stripes again today with the front month futures contracts changing. Jason, I want to start with you. Invesco runs the Invesco oil ETF, the oil fund. It's just symbol DBO there. That's the main competitor to USO out there. Can you explain to us a little bit about how this works and how, if any way, it differs from USO to us?
Sure. So USO and DBO are similar in that they're both ETFs and they both hold WTI futures contracts, but that's about where it ends. DBO, since its inception over 10 years ago, has always used an optimization process in selecting which futures contract to own. Occasionally, they own the front part of the curve, which USO used to own exclusively until the several changes recently. As you mentioned, now they're spread out across maybe the first 3 to 4 months of the futures curve. DBO, before every futures roll, looks 1 year out the curve and makes a calculation as to which futures contract offers the best annualized roll yield. In other words, the best cost of carry. In some cases, it's actually positive income if the futures markets are backwardated, downward sloping. Obviously, we're in contango. Super contango is a word that we've seen bandied about. But essentially, contango means that there's a negative cost. There's a cost and burden on the investor to hold that futures exposure over time. DBO seeks to minimize that cost in the contango market. We currently hold the March 2021 futures contract, which is pretty far out the curve, and it hasn't really been subject to some of these issues we've seen in the front of the curve.
Well, I love this word optimization process. Essentially, it's a rules-based thing, right, where you're trying to minimize the effects of contango. But I wonder, how could you make money? I mean, given that the whole curve is essentially in contango, how do you, maybe you can avoid losing less money. Is there actually a way to make money, assuming you just invest a certain amount and stay in? Isn't there a real danger, even in the way yours is structured, to just buy and hold strategy? Is that even advisable?
Well, it really depends on what the investor's expectations are and what their time frame is. So funds like USO give you a high sensitivity in the short term to daily moves in price crude. Well, used to until today. Now that sensitivity's declined. But the whole idea was it was a good trading vehicle for short-term traders. If your view is that crude oil is going to move in one direction or another, in this case higher, over, say, the next 8 to 12 months, DBO, you can look into that, and in the contango curve right now, you know the DBO owns the March 2021 futures, and it will hold that futures contract until about a month before expiration, about 3 weeks. And then it will, again, do that optimization calculation and then make the roll. So you have a great deal of transparency as to what your exposure is going to be in DBO, and then you can do the math. So if you buy DBO today and that futures contract is $29 a barrel, you know that if you're above $29 a barrel minus management fees, you have a chance to profit from that. So it just depends on your expectations and your time frame.
One of the things that's disconcerting about USO is they seem to be changing. You don't really know what you're investing in at any time with USO. Would I know at any one time what I'm investing in DBO? Is it predictable from month to month that you're going to be rolling over into certain contracts that are 9 months out, 11 months out? Predictability is important here, obviously, if you've got an opinion on oil.
It is. We think it's the best balance between predictability, transparency, and having some sort of dynamic optimization. So you have transparency that DBO's index is going to hold that, and DBO's purpose is to track that index, right? It's going to hold that contract until right around February 1st. Then, depending on the shape of the curve, it will roll to another futures contract. Now, if the curve for some crazy reason ended up in backwardation, it may just roll from March to April and collect the highest possible roll yield. If we're still in a contango market, it will likely go further out the curve to minimize that contango again. So
the answer to this question
up until the roll date. Sorry.
Right. So the problem here is it's rules based, but you can't really predict exactly what you're going to do. I understand your point. And Tom Todd, you guys jump in here. You're old hands at this. You've been seeing what's going on with USO here. They changed the investment methodology probably 4 times in the last week and a half. They're now not investing at all in the June contracts. They're only in the July conference. So today, and presumably the next 2 days, they're selling that June contract. One reason I think oil futures are so much under pressure, and they actually own a June 2021 contract, or will be owning it. They've announced. I guess, Tom, what is there something to be learned by all of this? We've obviously had a bit of a mess here. I guess what I'm concerned with is, should ETF investors sort of know a little bit more about the dangers of investing in commodity pools where you've got this contango issue? It seems like we had an awful lot of retail people invest in it, even though the dangers of doing this have been known for a long time. Tom?
Yeah, absolutely, Bob. You hit the nail on the head. I think a lot of investors were thinking that in buying USO, they may be able to profit from future oil prices when people start driving cars and flying in planes again. But what, in fact, they bought were people not filling up their tank and a bunch of tankers full of oil sitting off the coast, and it didn't translate to them. So to your point, you got to look under the hood. What Jason is saying here is we're in a situation with DBO where in buying that March 2021 contract, there's a much better chance that if we do get a recovery in the economy, that those that are investing may be able to participate in that rebound. But if they don't happen to hit it dead on, they can go forward into other contracts down the road once we get closer to that March 2021 date.
Right. Todd, I guess just pushing this question about warnings to investors, some have argued that essentially, you're buying futures contracts here. If I wanted to open an account at Ameritrade and trade futures contracts, I'd have to sign a FINRA statement saying, oh, yeah, I know exactly what I'm doing and I could lose money and they could go negative and all a disclosure. But you don't have to do that owning these. Should there be some kind of, should people who are supervising these, the SEC, or perhaps the financial firms themselves who are selling these, be required to do some kind of disclosure or have more education here? I'm trying to get at the point of avoiding this kind of mess with the retail investors.
Yeah, these kind of products that use futures are more dangerous for investors. It makes it harder for them to understand what they're actually owning. And just to drill down, USO and DBO have a 6 basis point difference in expense ratio. And if you look over the last 3 years, it's over 2,000 basis points in performance. So you really need to understand what's inside the portfolio, how these are different, and then determine if these are even appropriate for you and your client.
Yeah, it's a tough situation. I just want to move on here and note a couple of things here about oil ETFs that are getting in the news. So we had Diamond Offshore, which is one of the big offshore drillers. These are all penny stocks now, Noble and Offshore and Transocean, declaring bankruptcy. This is Diamond Offshore, DO, today. And so we see some of these small cap energy stocks affected here, including one, Jason, that you run, Invesco Small Cap Energy. That's PSCE. It's down about 4%. This is a market cap weighted index of small cap energy stocks. We also see XES, which is the Spider Oil and Gas Equipment one. That's an equal weight index. It's down at this point. I know that there's not a lot of money left in any of these, that they're essentially small caps, but did you see any interest in people, Jason, coming in and playing this like we had recently, for example, with the oil ETF? Any more new creations or redemptions here in any of these?
Well, we haven't seen a lot of flows on the small cap side. Obviously, those are the firms that are typically the most at risk of insolvency or bankruptcy in this environment. So for clients who are looking for ways to play the rebound in energy prices through an equity and energy equity, we've been recommending larger cap exposure for those companies that have the balance sheet to weather the storm, but will still benefit from higher prices down the road.
Yeah. Can you have any particular?
So just to add on to that, Tom. I mean, you've got a lot of situations where balance sheets are in tough shape. However, there are some smaller cap companies that actually have they're in better shape. I think when we do see things turn, and that's what a lot of investors are looking for. They're looking for hope down the road, and when things do turn, smaller companies are actually more nimble. They can ramp up more quickly, and right now they're closing down more quickly, hopefully saving as much cost as possible.
I think he's right. I think the key with the smaller cap, the key with the smaller cap names is to be diversified, right? He's absolutely correct that when the turnaround or the bottoming occurs, those names that survive will be very well poised and to profit handsomely. Yeah. And from a total return standpoint, obviously the upside is bigger than in the large cap names.
But that's the big. Jason, Bob. Sorry, that's the big challenge.
Jason,
Go ahead. I'm sorry, Bob.
Go ahead, Todd.
I was going to say that the leverage for some of these small cap companies, I think we really have seen driven home with the bankruptcy of Diamond Offshore. If you look at some of the more market cap weighted oriented products in exploration and production, like IEO, which is heavily weighted towards ConocoPhillips and EOG Resources, those are companies that have much stronger balance sheets that are likely to survive the volatility that we're seeing within the oil markets than these smaller companies.
Yeah. Jason, before we moved on from energy here, we spent a lot of time on this. The big question last week I got from investors, and I tried to explain it. Maybe you could take a stab at this. Explain why the price of futures contracts could go negative, but the price of the ETF futures can't go negative. They won't go negative. Can you explain that?
Yeah. Right. The ETF shares, there are several safeguards in place. So from a regulatory standpoint, we as the sponsors have fiduciary responsibilities as a sponsor of the ETF. And so whether it's segregation of assets and collateral, leverage, all these types of regulatory protections that have been put in place to prevent the NAV of the ETF from printing below zero. So the fund managers will deviate from the index methodology if they believe that the fund is at material risk of falling below zero from a NAV value standpoint. The second is that the stock exchanges are not set up currently to process negative equity trading. So on the stock exchange side, what you would see is the ETF trading would be halted before the fund hits zero and would probably be delisted thereafter.
Yeah, that's my explanation. I've never seen that happen. They'll just, even at the NYSE, you go below $5, you start getting letters, and they'll delist you. So the basically forced liquidation, essentially, or at least a delisting will do it. I just want to move on here a little bit and talk about some other things in the news. We've seen Fang Stocks do really well, Tom. And the ETFs they're in do really, really well right now. I guess the big one for all the Fang stocks is the Triple Q. You have any quick thoughts on the money that it's the story that never dies? Those big five, including Microsoft, everybody just keeps loving them day in and day out. It's amazing to me.
Yeah, it's amazing how we've been talking about Fang stocks for so long, but they worked right into the whole stay-at-home world, online shopping, home offices, video streaming, kind of modern communication, right, Bob? So, again, most of them, following on Netflix earnings last week, are reporting this week. And as you point out with the QQQs, the Fang stocks make up 35% of QQQs. If you add in Microsoft, it's 47%. So it's a great way to play it as we continue to be quarantined in the stay-at-home world, because it doesn't seem that their businesses are going to get weak anytime soon. They just continue to pull away from the pack.
Yeah. Todd, we had talked briefly about when's the COVID ETF coming. This is a grim joke, but it is coming. I know Direxion filed for a work-from-home ETF recently. There's some that overlap here, like the cloud computing funds that are out there. Robo, the investing in robotics, next generation communication ETFs. I guess FIVG is out there. Any thoughts here on whether we're going to see a wave of these ETFs? They tend to come, these fad ETFs tend to come a little bit after what happened, but this may go on for a while.
Well, I do think we're going to see that. So we're seeing some other firms enter with filings for work from home that are combining a number of these different themes. But the existing products, you think of a product like CLOU or BOTZ, both of those are from Global X. Cloud computing, robotics have been the themes that I think have been driven home as people need more bandwidth, to be able to work from home as companies realize that they need to be more of an automation and use robotics when they can to improve the supply chain. So I think some of these themes are really going to resonate with investors even more in 2020 than they have in the recent past. And there's a whole host of these products from First Trust, from Robo, from other firms that are really in this space for investors that want to dig deeper into how you can play this stay-at-home theme.
Yeah. Jason, explain how thematics work here. I mean, you run one of the big 5 ETF families that are out there. Do you guys have an investment committee where you get to sit down and say, hey, you know what? We need a stay-at-home ETF. How does it work to decide to have something on a thematic basis like this?
Well, we do try to be responsive, clearly, to changes in the structure of the market or fundamentals that would suggest that you have an investment theme that makes sense. We are probably a little bit more conservative in that durability of the theme for us is a very high priority. So if there's a risk that the theme may only have a year or two or so before it runs its course, it's probably not going to make it through our process. But if we think it has, 5-10 years or more of durability, then it certainly makes sense to us.
Yeah, I would think so. Finally, I just want to end on the gold ETF. The money just keeps coming into it, guys. I think we've had the highest level of shares outstanding since 2013. Gold itself, the price of gold, is the highest level since 2013. But the money just keeps pouring in. Anybody want to jump in on this? When is it going to? I guess it makes some sense. I'm just amazed because the creations are been really steady this year.
Well, Bob, it's one of those things where you've seen that the hedging from gold has really worked over the last 30, 40 years. And central banks have also been piling into gold, too. On top of that, gold demand, especially in emerging market countries, as many of these emerging market countries have enjoyed the growth of global economies. You've got the middle class that's buying gold. That's where most of the demand is coming from, for sure. But on top of that, supply has been really tough because it's not that inexpensive to get an ounce of gold out of the ground the way it used to be.
Yeah, the refiners, some of them are shut down too. Go ahead, Jason.
Yeah, that's what's unusual this time, as you guys just mentioned, was that you've actually got a decrease in the supply of gold while the demand is going up. And it's pretty unusual to see the actual production of gold be influenced while prices are rising. So you've got a double whammy there. You've seen institutional price targets going from 2,000 to 3,000 this week by some pretty well-known research desks. I haven't seen that before. It does remind me a little bit of the spike in gold we saw following the 08-09 financial crisis and the stimulus that was enacted then. And I guess this time will be interesting to see, are people buying gold because of inflation fears? Obviously, the inflation didn't pan out and we saw a huge retracement. On the other hand, gold has done pretty well over the decades. And so it's not that you want to short gold long term, but it'll be interesting to see how sustainable the demand side is, and especially as supply comes back online.
Well, that's my point. The demand side, the two biggest drivers of gold demand in the world are the consumers in China and India. The demand is down there. Certainly the demand for jewelry is going to be way down. I understand how for investment amongst people in the U.S., it'd be fine. But everybody I've talked to about jewelry demand in India and China indicates way down at this point. So I guess it always amazes me. With gold, when you're talking to gold nuts, I had to do that special in 2011, and I spent a lot of time talking to people who believed in gold as an inflation hedge, believed in gold as a zombie apocalypse protector. Gold attracts a lot of emotions around people, and it always amazes me. I have to say, I gained a lot more respect for gold recently, though.
Well, the only the only ETF to see more inflows in the past week than USO has been GLD. So I guess you can pair those two commodities together.
Yeah. I would also just add in there that from a I was just going to say low interest rates globally now for the foreseeable future is also a tailwind for gold.
There's another one: inflation hedge, low interest rate protector, zombie apocalypse shield. It's anything you want it to be, folks. Todd, thanks very much. Tom, Jason, thank you very much. It's a long story here about gold and ETFs, folks. That does it for our ETF Edge this week. You can see all of our videos on a daily basis, of course, etfedge.cnbc.com. That's the important thing, folks. We'll see you the same time, same place next week. Thanks for joining us.
Get the ABCs of ETFs with the ETF Edge newsletter, your weekly update on the hottest trends in the nearly $4 trillion market of exchange-traded funds, expert analysis, actionable ideas, and exclusive insight from host Bob Pisani. Sign up now at cnbc.com/ETF Edge newsletter.